And there's a very small number of founders out there who understand that you want to go with a VC that has a long-term reputation of taking care both of the successes and taking care of the failures. And that's a very rare reputation to have.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave.
VCs can add value. So this is a great chart by Boris Golden at Partech. He called this the Maslow's pyramid of VC value addition, similar to Maslow's hierarchy of needs. What is most important is at the bottom, and what is the most value add is really at the top. But I think it's really quite key because most people, every VC says they're value add, right? Which is like how every brand of milk says they're healthy, right? No matter how unhealthy they are, every VC says they do value add. But let's walk through that, right? So the first thing that's really important is, obviously, every VC has to bring money to the table. So do they have money, and do they actually deploy that's there? Second is, are they non-toxic? So in other words, do they destroy value? So there are known VCs out there that have bad behavior. They don't show up for board meetings. They hold up exits. I know one founder whose company could have been acquired. Basically, it was blocked by a certain set. The reason why was that this acquisition was not a great acquisition. It was only going to give out cents on the dollar effectively, but it's an acquisition. You were given a story to the founders. You have gotten you some money out of the money that you VC had put in, but it was blocked by one set of blockers. And then eventually they could not convince the VC to override the veto of that acquisition. And so eventually the whole company just had to wind down to zero. So the company operated for half a year more, never got out of it, and then everybody got $0 out of every dollar you put in. So there are VCs that can destroy value, right? So people could be like, get cents back, but now I got 0 cents back on the dollar I put in, right? But I think we see that actually in different ways as well. Next, of course, is reinvestment potential. So if a VC puts money in again, it's a very good signal. I think it's very important to have VCs that have the ability to double down on you, and that's a very good signal to the new investors coming in. The next is shareholder duties. Can you do your checks and balances? So are you able to help be a good board member, make sure there's good governance, like the basic hygiene that you have? And then after that, this is where we get into all the sexy stuff that's often on people's websites, like network and platform. Are you able to bring in community? Because VCs are meeting so many people every day, every week, every year. So can they bring the right introductions and community network? And at the top, of course, is one-on-one executive coaching and support, chemistry of the founder. So this is like Maslow's hierarchy of needs. So yeah, LP Deck would normally focus on this top value add. So it's kind of like an iceberg, right? These top two is what's poking above. But I think the more experienced founders will actually focus on what's below the surface, because these things are actually really key, but they will not be mentioned in your LP deck. And also, yeah, because imagine you go on the website, right? Our VC is so fantastic because we give you money. And everyone's, duh. And we're not toxic. And everyone's, oh shit, are you toxic? And we can reinvest in you. And everyone's like, can you reinvest in us? And then we're very good compliance people. And everyone's like, we don't want compliance. So there's like this kind of very weird dynamic where everybody's using the sexy marketing terms of value add, ecosystem platform. So if you go and look at all of the, like you go to a grocery store, right? Everything is natural, right? So natural is not a protected term. There's no definition of natural. There's no trade body that protects what natural is. Everything calls itself natural. Now, organic is protected, so that's the additional word that primes people. But if you think about it from a first-time entrepreneur, you don't know you can talk to Jeremy about this person. How are you going to do reference checks? One of the advice I often give people is, hey, if you're a first-time founder, you got this deal, you still need to do your reference checks. You need to call the portfolio companies, the companies that succeeded, of course, but of course, talk to the companies where they failed under VC's care, learn from the experience, how the experience was, right? I know one experience where I talked to a founder and he was very much like saying, yeah, Jeremy, I really recommend this VC because our company was failing and I have kids and stuff. And then the VC was like, I can't support you, but I'm happy to give you a personal loan to help you through this time as you go through this process. And I was like, wow, what a story. The company's failing, but the VC is giving his own personal money to help support through this tough time. And so for me, as Jeremy's, my perspective is my rating of this VC went up, right? Because this VC is actually doing his best in that situation. But again, it goes back to that earlier cost that we had, right? Which is VCs have a limited amount of time and resources. And some of the brutal reality is that helping these underperforming startups drains your ability to support or cost correct the companies that are going to be home runs. So I think that's actually I'm just saying, this is a very difficult piece. So if you're a founder, 90% chance you're going to fail. So you need to know from VCs how they treat failures from a personal and professional career perspective. But from a VC perspective, you're primarily compensated on your home runs, not how well you treat the failures. And there's a very small number of founders out there who understand that you want to go with a VC that has a long-term reputation of taking care both of the successes and taking care of the failures. And that's a very rare reputation to have, and also very expensive to prove out, and people may never find out anyway. But then I think what people realize is that you can build big companies in the transfer payments component, right? Because Visa, MasterCard are billion-dollar companies that are taxing remittances, for example. So what I'm trying to say is, like, people are right to say that crypto can build big companies, but it took a long time for people to realize it's not going to come from the currencies or the NFTs. It's really going to come from the transfer and movement of money dynamic, right? So I think good VCs can shepherd or course correct or guide startup founders towards the right track and be the right advocates and champions for that trajectory of the whole sector. So even today, we look at AI, we are still in a big debate. Is it applications going to win, or is it going to be picks and shovels? Infrastructure is going to be a win. And probably there are going to be winners in both lanes. But even within applications, how exactly you should do it, which market you're going to, you don't really know. So we're all figuring it out together. Now, in 10 years' time, I'm going to tell you right now, there's going to be a bunch of billion-dollar companies in AI, and everybody will be like, oh, it's a no-brainer, it's super obvious. Hailing is a solved technical problem and a solved business problem, right? We understand what two-sided marketplaces are. We understand the economics of it. We understand the margin structure of it. We understand the demographics that need to happen at a market level. It's fully solved. But at the point of time in the technology that we're making investments today is not solved. And so I think VCs who are on the board that get the vote for certain strategies, that can approve the budget, that can veto, that has one-on-one time to coach and counsel, have a strong responsibility to help that. So I think the crux of it is we don't know, but we have to figure it out together. So similarly for VCs, I think people have to decompose the brand of the VC, which can be a big signal. So obviously the famous ones in the world today would be Andreessen Horowitz, A16Z, Y Combinator, et cetera, et cetera. But as we saw so that's the company brand, because they're doing an active effort to do outbound and inbound marketing, right? To do podcasts, be on the news cycle, write books. So they're doing the effort. So there's a signal for that. So there's a market signal that comes from a famous VC coming in. So you look at Benchmark, Union Square Ventures. Most people don't really know who they are, but they have a very high quality selection rate of good companies. They have a high ability to pick, right? So for you ask me, as a more clued in person, I pay much more attention, if that makes sense. Because Tech in Asia is always going to be like, and TechCrunch is always going to say, what's the most visible, what's the mindshare thing, right? Is the most controversial thing to create the eyeballs. But for me, I'm probably more, okay, it's like, what is Warren Buffett doing? So Warren Buffett cashed out of Bank of America, all their stocks. And so everyone's going to be like, what is Warren Buffett saying? Is he saying they're at the top of the market, stock market? Is he saying Bank of America has too much exposure to the interest rate changes that's happening? So people are listening to Warren Buffett because people feel like he has a good judgment call. So similarly, I think we need to decompose when I say signal. Is a signal from a VC fund or a signal coming from a good VC partner, if that makes sense? Because the judgment is there. Then if you're saying that, then you can tag along some of that thing. So for example, there are funds that say, we pick within Y Combinator, right? So we're saying that Y Combinator system is a generalist, like index fund in that sense, but like a Harvard is a big portfolio, but we still need to search within that group for who are the best home runs, because what we saw was that less than 1% of Y Combinator companies become unicorns. But it's still 1%. So I think you got to do that further work. And the truth is that the other thing I have to add is that if you're following a signal that's there, to some extent, everyone else also sees that signal. And so the price of the asset also goes up. So for example, if I know that this very good asset picker picks it, if we know that Warren Buffett invested in this stock, the stock price goes up, everybody's trying to buy that more expensive price after Warren Buffett has come in, right? And so how much more upside do you have left after that market price correction, question mark? So I think that's really like the piece that I think there are VCs who follow the signal because it's much less work in terms of informational costs, transaction costs, and also good VCs tend to be doing more value add, so you can do less work. So it's like a lower cost to run the transaction, but then you may have more limited upside, because the good VC will swallow as much of that. And then the other component is you don't look at Y Combinator startups because they tend to be overvalued as a rule, but you're looking for the people who have a weird background. They didn't go to an American institution. They went to a local Southeast Asian university. They never applied the Y Combinator, but they've done a good business. And then you want to invest in them. Yeah, I mean, so I think that's the kind of like the two strategies. Is like, one is, do I follow someone else's signal versus if there's a signal, it's really overpriced, I need to go and hunt the people who are underpriced that has the right reward for me. So I think Uber as a company was facing the possibility of a speed trap. And as we know, the VCs that were on the board played an instrumental part in the kind of change of the CEO. But I think it's still very contentious. The VCs that engineered this change of CEO had seen during that time frame from the other portfolio companies that there were similar issues. And so because they had learned from that mistake, they were more aggressive in turning over the leadership at Uber. But that VC fund actually suffered reputational loss across founders because founders basically said, hey, you can be a high-performing founder, and then this VC can backstab you, quote unquote, and change you as a CEO. So they took a reputation hit. But then you can also argue that they didn't mind because they shepherded Uber to a continued financial success, right? So they're acting in the financial duties of the company. There is, of course, a mismatch between VC's self-perceived value or value add versus, I think, the actual performance of VCs in terms of value addition. So 92% of VCs say that we add value. Only 8% of VCs will say we don't add value. 92% will say we add value. But of course, if you do the analysis, again, this is also available from Forward Ventures, but basically the survey showed that only 39% of founders will evaluate that the VC provided average or above average value add, right? Which is a very wide bar, right? And so I love this meme about this is what you promised to get versus this is what you actually get, right? So it is what it is. And yeah, so every VC is going to be a kind, charismatic, inspiring LinkedIn influencer with a podcast. And so I think if you decompose this a little bit into this from another company called Crendum, but basically what they tried was say, hey, if we can divide this into value add, like we support you in recruitment, we support you in introduction to marketing, we support you in figuring out your growth and management strategy, we figure it out in terms of helping you raise your next round of money, and we help you with corporate introductions and other types of support. So what is that? Generally, there's a big mismatch between VCs. A lot of VCs say, wow, I was very important. 60% thought they were important for helping with recruitment, but for founders, only 19% thought they were important, right? So the vast majority, 79% of founders felt that the VC added insignificant value on recruitment, right? So what a dramatic mismatch on whether VCs actually add value in terms of recruitment. And then similarly for introduction in terms of marketing, growth and management strategy, and corporate and others. So I think, but what's interesting, of course, is that the one place where they did match up, of course, is in terms of follow-on financing, right? So VCs know other VCs play poker with other, swap notes with other VCs. And so when a VC says, hey, you should invest in my company because I did a good job shepherding this company for the past 2 years, the other VC is willing to pay attention because the VC is taking their personal reputation on the deal, right? And so why is that? Most 94% of VCs said that they were important or critical for follow-on financing. And it turns out that 81% of founders agree with that statement as well. So I think that's one area that I think you have to understand that VCs are really good at. Is like they can help you. And then the VC was like, can I give you a call? And I was like, okay. And then I did a call and the guy was like, yeah, just don't do it. This guy is this, never does the board updates. It's like a mess. So just don't do the deal. And I was like, okay, I'm not going to do the deal, right? Because this guy has insider information as the board observer for the past 2 years, right? Does that make sense? So that's a very important piece of information that's very key. There's something to be thoughtful about. And I think my last slide here is that I think what's interesting, I always like to talk about, is if you look at VCs and come back to skill and performance, they tend to fund people between the ages of 20 to 34, right? So that kind of like encompasses, like I'll say about 2/3 of all companies that are unicorn founders are started at this age. But what's interesting is that if you actually look at the analysis of like founder age and their percentage chance of success, so what this chart shows is, hey, what are your chances of success? And what I saw was like, hey, like 25, 35, 45, 50, like actually your chance of success rises from 0% to 0.1 to 0.2 to 0.25%, which is not very high if you think about it. 1% is 1 of 100, 0.1% is 1 out of 1,000 people. So it's just saying, but your odds do get better as you get older. And so you can see there's actually a peak around the age 50. So if you, for example, like if you have been working for 20 years in, say, a certain problem like finance, you have the connections and so forth, and now you want to build a company that does a debt syndication platform as a startup, for example, I'm just making stuff up here, but it's actually quite difficult to do if you're like 20 years old, you don't understand the space, you don't understand the connections. But now after doing 20, 30 years, you saved up $1 million, your kids are off to college, you don't care anymore, you have lots of free time, and you're like, you know what, I can build this company, I have the connections. I think older founders do have a little bit more of that juice. And what's interesting, of course, is that as an older founder, because they have more resources, more connections, they tend to be more efficient in their capital on one side, but they also tend to have more personal capital and can attract capital more easily. So VCs will find it more difficult to deploy capital to older founders on average, because the older founders generally will say something like, wow, this valuation is too cheap. Why would I give you $1 million for 20% of my company? Because I already have $1 million of savings. So I don't need this money. I would only accept this money if you give me $1 million and I only sell 10% of my company, for example, which kind of breaks some of the risk-reward dynamics for VCs as well. So I think there's something for you to be thoughtful about, is that VCs are funding younger entrepreneurs on average who, again, we talked about it, right? Because VC funds can add value, but obviously you're going to add value to younger, generally less experienced founders. And then as you get older, you get more successful, you get more experience, then that value, your ability to make your own luck is within the founder. And then they have less need for VC value add, less need. And it doesn't mean they have no need, but I'm just saying that, and then that affects the transactions and so forth that happens.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.